Hey everybody, Courtney Smith here, and I just wanted to talk about how the Fed is driving the economy off a cliff. You see, the Federal Reserve has put themselves into a box that they can't get out of without very severe economic consequences. So let's take a look. What we saw was one of the most mammoth increases in money supply in history, up 800% in about a year. And of course, inflation is always a monetary phenomenon. No, it is not a supply chain phenomenon. It is not an oil problem. It is not a Vladimir Putin problem. It is caused by money supply entirely. So what happened is they pump all that in. Then, of course, we see the Trump and Biden administrations do massive fiscal easing as well. So that doesn't help the situation at all. But monetary policy is the key. So all of that monetary policy, if you've been watching my videos here, you know that causes inflation, and inflation is here. We told you that here on this channel, gosh, almost 2 years ago, okay? And been covering it ever since. So now we have 8-10% inflation, depends on how you want to look at it. Now, how does the Fed stop that inflation? Because 10% inflation is something very bad for the economy. Now, what do I mean by that? Well, every American's purchasing power is declining by 10% every year. So I used to make $1,000 a week at my job. That's only worth $900 now. So my real wages are declining. And as a result, all Americans are getting poorer. Now, the richest of rich, they make more money because the inflation can help out their investments. They can help the stock market out. But for the average person who doesn't have a big stock portfolio, all it is bad. Now, it doesn't affect Jerome Powell. He's got a nice gig going there at the Federal Reserve Bank, but it hurts the average American. So that's a disaster right there. So in the minds of the Fed, what they have to do is they have to raise interest rates and also reduce money supply. And in fact, that's exactly what they're doing. But that's going to lead to another problem. So first of all, let's take a look at what are they doing. Money supply growth is collapsing. It's still positive year over year. We still have money being issued by the Fed at a higher rate than a year ago. But whereas it was growing at an astronomical nosebleed level, it's now down around 10% growth. So the momentum of the growth is declining, and that is a leading indicator of money supply. So we're going to start to see money supply actually shrink or grow at very small levels very soon, and that's going to help out inflation. But what else will it do? That liquidity is going to hammer the stock market. The stock market was able to be in one of the largest bull markets in history during the pandemic simply because the Fed flooded so much liquidity into the economic system that caused stock prices to rise significantly. Now, when he takes that liquidity out of the system, stocks will drop significantly. We're already seeing the beginning part of that phase. The second thing that he's doing is they've just announced that they're going to raise interest rates. Great. And he has to do that. But this is way too late. Typically, since World War II, the only way you can reduce inflation is to raise short-term interest rates above the level of inflation. If inflation is 8%, he's got to raise Fed funds to above 8% in order to stop the inflation. Now, let me ask you a question. You think he's going to do that in your lifetime? No. Right now, the Fed is talking about getting up to maybe 3% in 2024. That's not going to stop inflation. If he sucks out a huge amount of liquidity, that could do it. It's got to be either interest rates or liquidity, or preferably both, in order to control inflation. We always have to look at the supply of money and the price of money to understand Fed policy. So they're going to start to, instead of issuing 120 billion of bonds every month, they're going to go to 110 and then 100. This is still massive easing. That's good for the stock market, which is why the stock market may not have some major crash. But if he takes liquidity out of the system and raises interest rates, that's going to hurt the economy, and we will have a recession. The raising the interest rates, not enough to stop inflation, will slow the economy and cause it to go into recession, but won't solve the inflationary problem as much as he wants it to. In other words, it may peak out at 8 or 10% and it won't go any higher, but it's not really going to go any lower until he raises interest rates to about 8 or 10%, which he's not going to do. So what has he done is he's set up a situation exacerbated by the federal government budget deficits, but mainly it's due to him and Janet Yellen and Ben Bernanke, and you see all these Fed chairmen, they all did the same thing. But now we're reaping what they sowed, which is stagflation. Stagnant economy, maybe recession, and also inflation. And we're also seeing inflation get to the point where it's becoming sticky. Now, I've been talking about this for quite some time. The initial stages of inflation are led by raw materials. And we've seen the huge raw material explosion, and that raw material explosion will continue. It'll be different raw materials. We just saw nickel double in one day. But we're going to see oil come down and moderate a little bit for a while. We're going to see maybe grains moderate for a while, livestock moderate for a while, and then they'll start to have another leg up later in the year. So inflation's not going away. So what's going to happen is we're going to see a slowing of the economy to the point where it will be a recession. Germany is already in an official recession, 2 quarters of negative growth. We're going to start to see the U.S. have the same thing. Now, when is that going to occur? Well, I'm not quite sure. It could happen as early as late this year, but I think 2023 is the year when all of the policy changes that the Fed is making really bite. Because you see, what happens is when the Fed makes a policy change, and this is a big one, it takes 3 to 6 months for it to actually work its way into the economy. So that would bring us to fall of this year or winter of next year would be my best guess at this point. So what can the Fed do now? They created a terrible situation, and now they're going to have to make some very hard decisions in order to stop it. Now, the traditional way is you raise interest rates to above the rate of inflation, and that's how you kill the inflationary monster. I don't think he's going to do that for 2 years, 3 years, if ever, which means that real wages will continue to decline and the U.S. economy will be roughly in a stagflationary situation for 2 to 3 years. However, it doesn't matter to us as investors. It matters to me as a citizen because I don't like to see my fellow citizens suffer caused by 13 wackos in Washington, D.C. That just is offensive to me as an American. But we as investors can take advantage of all of this because there's going to be a lot of volatility in the marketplace. And one big advantage that we're seeing right now is that it's not a stock market, it is a market of stocks, which means some sectors are going up, some sectors are going down, which means we can make money buying stocks even in this environment. And at the same time, we could be buying some sectors and selling other sectors, or doing things like buying some sectors and short selling SPY or buying SQQ, in other words, a bearish whole market strategy, but buying sectors that are outperforming and actually in bull markets. So there's a lot of money we can make right now. So on one hand, I'm depressed as a citizen. On the other hand, as an investor, I'm pretty happy. Talk to you later.